So far, there are some REITs that started doing well with higher dividends being declared for this quarter. However, there are some REITs that experience drop in dividends instead. In this video, we'll analyze the results from Mapletree Pan Asia Commercial Trust that experienced a huge drop of 7.3% dividend year over year and Fraser Centrepoint Trust business updates. MPACT is a retail and commercial REIT mix of Singapore and overseas properties, while FCT consists of properties purely in retail sector in Singapore. MPACT is a much larger REIT as compared to FCT. However, we will see again why is there a huge performance difference between these two REITs, even though they are in the same sector. Let's go on to the first REIT, and that is Mapletree Pan Asia Commercial Trust. MPACT is a very big REIT with assets under management of 15.7 billion. They contain properties of retail and office properties, with Singapore holding the majority at 55% of the overall assets. VivoCity and Mapletree Business Centre takes up bulk of the SG property valuation. They also have Hong Kong Festive Walk Mall at 26%, while China properties are at 10%. So do take note of this percentage of these overseas properties, as they will play a very important part into why MPACT experienced a drop in the dividends. We see this slide. They have proposed to divest Mapletree Anson, which is an office building in Singapore. Based on the information, it seems like the selling of the properties will be used to pay down their debts. With the paying down of the debts, it will be a 1.5% DPU accretive, because interestingly, the drop in the finance costs for them will be more than the loss of income from this property. I have mixed feelings about this. As I mentioned in my previous analysis video, Singapore properties tends to perform better due to dense population and attractiveness for companies to open in Singapore. That is why their occupancy is at 100% with net property income of just 3.8%. The net property income is low because it's valued at a much higher rate as compared to most of the office properties. We can see from the original price purchase of 680 million to the divestment of 775 million. This is a very good increase. However, even though it's beneficial now, selling away quality assets is never good for the long term, unless the new properties that the management purchase in the future can perform better. Else, it's always not desired to sell away quality assets. Looking at their results, revenue and net property income was essentially no change year over year. Even though the operating expenses dropped 1.1%, finance costs increased significantly by 9.8%. This led to a drop in distributable income and DPU of 3.5% and 4.1% respectively. This is disappointing, as most REITs are currently having higher revenues due to positive rental reversions. But this does not seem the case for MPAC. To add on to the concerns, their finance cost is still increasing, which means that the refinancing of the cheap debts are still happening. The finance costs will still continue to increase as long as they have cheap debts that are still required to be refinanced to the current interest rates. If we try to find the root cause for the significant spike in finance costs, we are able to see that the average cost of debt increased significantly from 3.35% to 3.54%. Like I warned in my previous analysis video on MPAC, they have lots of debts that needs to be refinanced in the next 3 years. Assuming that there are cheap debts, it will continue to cause their finance costs to increase. In MPAC's situation, it is quite bad. Not only does the revenue or property income is not increasing, their finance cost is expected to increase more. This will mean more DPU drop that will be expected in the coming quarters. Coincidentally, for Fraser Centrepoint Trust, which I'll analyze later in the video, their cost of debt is at 4.2%, even though they have a credit rating of Baa2 stable. With MPAC having a lower corporate rating or at Baa1 negative, this will potentially mean that the renewal of their debts will come in higher than their current cost of debt of just 3.54%. Let's take a look at their portfolio performance. Like I mentioned, for retail, it's important to see the tenant sales and the shopper traffics. However, for both Vivo and Festive Walk, which together contributes nearly 50% of MPAC's overall income, are experiencing drop in both sectors year over year, and that is not good. I previously mentioned about my concerns with the post-COVID rebound, which caused a lot of traffic into the malls. However, as it normalizes and people start going overseas, traffic for the malls might be expected to drop. This is what we are seeing, as the tourists coming to Singapore might not be able to compensate for the drop in traffic from the locals. Overall rental reversion is at 5.2%, but tenant rental rate is only at 44.4%. This meant that they are unable to keep most of their tenants upon the expiry of the leases. Interestingly, if we see the properties of the rental reversions, Singapore properties are doing decent with rental reversions of 22.3%, 19.9% and 10.2%. But the other overseas properties are experiencing negative rental reversions, especially for Japan with 21 leases at negative 12.7%. This meant that half of the overall assets of MPACT are actually experiencing negative rental reversions, and that is just bad. One of the biggest assets, MBC, also suddenly experienced a drop in occupancy from 96% to 92.8%. If we look at the top 10 tenants, we can see the rental drop of 0.5% from Alphabet. Alphabet have been cutting office spaces, and I guess MBC might be one of them. Based on the leases, they have much more lease that were required to be renewed for the next few financial years. If the negative rental reversion rate for overseas properties continues, this might negatively affect MPACT income. Overall, what can we conclude from MPACT? Good points is that Singapore retail and commercial properties continues to do well. Divestment of Mapletree and Son to bring down loans, leading to higher income. However, the bad point is that overseas properties are not performing well with negative rental reversions. Potentially higher finance costs due to refinancing of their cheap loans. And lastly, because of the divestment of Mapletree and Son, it's always questionable because they are selling away priced assets. At the current share price, it's giving a dividend yield of around 6.28%, and I expect their dividends to potentially come in lower due to their refinancing of their debts. Fraser Centrepoint Trust is another retail REIT which is purely having Singapore properties only. They gave a business update which does not have much information, but we can get some interesting insights from it. For those who are not familiar with Fraser Centrepoint Trust, they are a REIT that consists of 9 prime retail properties in Singapore worth 7.1 billion. Even though it is just 9 properties, Singapore malls have very strong attractiveness unlike overseas properties due to the convenience and dense population in Singapore. For the previous quarter result, Fraser Centrepoint also announced a drop in DPU of 1.8%, but if you take a look at their points, it excludes assets of Changi City Point and Tampines 1. If they were included, it would have been an increase of 2.9% for the revenue, while 2.1% for the net property income. However, one of the issues similar to MPACT is that they have a property expense and finance cost increasing quite significantly at 4.1% and 16.6% year over year respectively. For their next first half of financial year 24-25 result, these are the 2 factors that I would want to focus on. If these 2 expenses continues to increase, it will definitely be potentially bringing down the distributable income to shareholders. If we see the overview, overall occupancy rate for all the retail malls are at a high of 99.7%. With all the malls doing very well, one positive good note is that for Tampines 1 that is undergoing asset enhancement or improvement to the mall, they are on track with 100% committed occupancy. The contribution back from Tampines 1 will be expected to help FCT significantly in their income. However, for retails, shopper traffic and tenant sales are something to focus on. For FCT, it seems like it's on a downward trend with year-over-year shopper traffic going down to 4.1% increase, while tenant sales only increased by 0.7%. Good news is that at least it's not negative unlike MPACT. We have to observe and see next quarter on how is the year-over-year change like, because currently it seems like both are slowing on a downward trend, which we do not want in the long term. Gearing ratio increased from 38.5% to 39.1% while having the same average cost of debt of 4.1%. This meant that their finance costs will be expected to go up due to the additional loans taken. However, FCT has some good news to look forward to due to the additional loans taken. With the higher finance costs expected, they have additional asset contributions for the next half of the financial year. With the addition due to the purchase of the 24.5% additional ownership of Next from their sponsor and Tampines 1 completing the asset enhancement, these two assets might potentially be able to increase the revenue by quite a big margin to offset the increase in the finance costs or their expenses. Additionally, they might have more income with leases expiring this financial year in these respective malls. Why? It's because Singapore malls are very attractive and are doing very well with high demands. If we see their previous quarter results, rental reversions was very good across the board with average of 7.5% increase, unlike MPAC which had overseas properties all having negative rental reversions. Overall, what can we conclude from FCT's results? The increase in the Next ownership and Tampines 1 will be expected to contribute to their income significantly. 4.3% of the total income of leases will be expiring this financial year, leading to higher potential income. Bad pointer is that due to the increase in the leverage ratio, finance costs will be expected to go up. Properties expenses might continue to go up due to running costs of all malls. And lastly, the slowing growth of shopper traffics and tenant sales might be a small concern. At the current share price, it's giving a dividend yield of 5.2%. I'm cautiously optimistic for FCTs for the dividends to maintain or increase due to the potential addition contributions to their income. So in conclusion, what is the summary for these two REITs? The main expenses, which is the property expense and the finance cost, is growing at a faster rate than the revenue or the income. This main factor will actually lead to lower distributable income and lower dividends. Next, for rental reversions, FCT definitely wins on this because they have very positive rental reversions for their Singapore properties, while MPAC is experiencing negative rental reversions for their overseas properties. Shopper traffic and tenant sales is also another factor that I will look at for retail REITs. Both are experiencing slowdowns, with MPAC having the worst with negative year-over-year drop. Thank you so much for watching. I hope this video brings a good insight with regards to these two REITs. Please support the channel by hitting the like, subscribe, and comment on what you feel about retail REITs performances. You can also watch my other videos where I analyze on other REITs or Singapore banks. Thank you, and I'll see you in the next video.